Welcome to Forex Central. We're thrilled to have you join our YouTube, Facebook and Telegram channel dedicated to all things Forex. Here, you'll find a community of passionate traders, investors, and enthusiasts who share a common goal of achieving financial success through the exciting world of foreign exchange. Stay tuned for regular updates, trading tips, market insights, and educational content that will empower you to make informed decisions and navigate the Forex market with confidence. We believe in the power of knowledge and collaboration, so feel free to engage with fellow members, ask questions, and share your experiences. At Forex Central, we're committed to creating a supportive and inclusive environment where everyone can learn, grow, and thrive. Our channel is designed to be a hub of valuable information, resources, and opportunities that can help you unlock your trading potential. Thank you for being a part of Forex Central. Get ready to explore, connect, and embark on an exciting journey towards financial freedom. Happy trading! Forex Central Weekly Gold Analysis for June 26 to 30, 2023. Forex Central preparable entry is a buy. Buy entry at 1921. Buy stop loss at 1908. Buy take profit 1 at 1933. Buy take profit 2 at 1940. Buy take profit 3 at 1950. For June 26 to 30, 2023. Forex Central alternative entry is a sell. Sell entry at 1952. Sell stop loss at 1965. Sell take profit 1 at 1940. Sell take profit 2 at 1933. Sell take profit 3 at 1920. For gold support and resistance analysis, support 1 at 1920 to 1914, support 2 at 1895 to 1890, support 3 at 1880 to 1975, resistance 1 at 1933 to 1940, resistance 2 at 1953 to 1960. For gold trend analysis, for long term it's downtrend, for short term also downtrend. For June 26 Forex Central preparable entry position for gold is a buy. Buy entry at 1921, buy stop loss at 1908, buy take profit 1 at 1933. Buy take profit 2 at 1940. Buy take profit 3 at 1950. Buy entry has a potential to reach 31.99 pips. Risk reward ratio is 2.49. It's important to remember that the Forex market is highly unpredictable and subject to various external factors. Therefore, conducting thorough research, consulting professional analysts, and using a combination of fundamental and technical analysis can help in making informed trading decisions. Please note that this analysis is for informational purposes only and should not be considered as financial advice. Always conduct your own research and consult with a qualified financial professional before making any investment decisions. For June 26, 2023. There is a lack of major news releases. When there is a lack of major news releases, the market can experience a relatively quieter period, with potentially lower levels of volatility. Here are some potential outcomes and characteristics during such times. 1. Reduced volatility. Without significant news releases, market volatility tends to subside, as there is a lack of fresh information to drive significant price movements. Traders may adopt a more cautious approach, leading to relatively stable market conditions. 2. Narrower trading ranges. In the absence of major news releases, trading ranges may become narrower, price movements may be limited, and the market may exhibit a more range-bound behavior, with prices fluctuating within a relatively tight range. 3. Lower trading volume. The absence of significant news can result in lower trading volumes, as market participants may be less motivated to execute large trades or take significant positions. This can lead to decreased liquidity in the market. 4. Increased influence of technical analysis. During periods with a lack of major news, technical analysis tends to play a more prominent role in guiding trading decisions. Traders may rely on chart patterns, indicators, and historical price levels to identify potential trading opportunities. 5. Focus on macro factors. In the absence of immediate news releases, Market participants may pay more attention to macroeconomic factors and long-term trends. Economic indicators, central bank actions, geopolitical developments, and other fundamental factors may garner increased attention. 6. Sentiment and market psychology. Market sentiment and psychology may become more influential during times without major news releases. Traders may rely on broader market sentiment, investor confidence, and risk appetite to guide their trading decisions. It's important to note that even during periods with a lack of major news releases, unexpected events or developments can still impact the market. Traders should For June 27, 2023, CB Consumer Confidence Report will be released. The market's reaction to CB Conference Board Consumer Confidence news releases can vary depending on various factors. Generally, if the released consumer confidence data exceeds market expectations and shows increased optimism, it can have a positive impact on the market. Conversely, if the data disappoints and reflects decreased consumer confidence, it can have a negative effect. Here are a few potential scenarios. 1. Positive impact. If the CB consumer confidence data surpasses expectations and indicates a strong level of optimism among consumers, it can boost market sentiment. This positive sentiment may lead to increased buying activity, potentially resulting in higher stock prices. Sectors such as retail, consumer goods, and hospitality might particularly benefit, as higher consumer confidence often translates into increased consumer spending. 2. Negative impact. If the CB consumer confidence data falls short of expectations and reflects a decline in consumer confidence, it can dampen market sentiment. Investors may become more cautious and adopt a wait-and-see approach, leading to selling pressure and potential declines in stock prices. Sectors relying heavily on consumer spending could be negatively affected. 3. Impact on interest rates. CB consumer confidence data can also influence the decisions of central banks regarding interest rates. Higher consumer confidence may indicate a stronger economy, potentially prompting central banks to consider raising interest rates to control inflation. On the other hand, lower consumer confidence might lead central banks to adopt accommodative monetary policies, such as lowering interest rates, to stimulate borrowing and economic growth. It's important to note that market reactions are not solely determined by a single news release, but are influenced by a complex interplay of factors, including overall economic conditions, geopolitical events, and other concurrent news releases. Additionally, market participants' interpretations and reactions to the data can vary, leading to fluctuations in prices. To gain a more accurate understanding of how the market might react to a specific CB consumer confidence news release, it's advisable to monitor real-time market data, follow financial news sources, and consult with financial professionals who can provide insights tailored to your investment goals and risk tolerance. For June 28, 2023, Fed Chair Powell testifies. When the Federal Reserve Fed Chair, currently Jerome Powell, testifies, it can have an impact on the market. Here are some possible outcomes and reactions that may occur. 1. Market volatility. Testimonies by the Fed Chair often led to increased market volatility. Traders and investors closely analyze the Chair's remarks for any hints about monetary policy decisions, interest rates, economic outlook, or future actions by the Federal Reserve. 2. Market speculation. The market may engage in speculation and attempt to anticipate the Fed's next moves based on the Chair's testimony. If the remarks provide clear signals or unexpected insights, it can influence trading decisions and market sentiment. 3. Interest rate expectations. One key aspect of the Chair's testimony is their stance on interest rates. Any indications of potential rate hikes or cuts can impact various financial instruments such as bonds, currencies, and stocks. 4. Economic outlook assessment. The Fed Chair's assessment of the overall economic conditions and future projections can significantly impact market sentiment. Positive remarks about economic growth and stability may boost confidence, while cautious or negative remarks may lead to market unease. 5. Currency fluctuations. Currency markets are particularly sensitive to the Fed Chair's testimony. Statements about monetary policy, inflation, or economic conditions can cause fluctuations in exchange rates, as traders adjust their positions accordingly. 6. Investor confidence. The Chair's testimony plays a crucial role in shaping investor confidence and sentiment. If the Chair's remarks are perceived as positive and supportive of the economy, it may bolster investor confidence and potentially lead to increased investment activity. It's important to note that market reactions can be unpredictable, as they depend on a variety of factors, including the Chair's remarks, market expectations, and overall economic conditions. Traders and investors closely monitor the testimony and analyze its potential implications to make informed decisions. For June 29, 2023, Thursday, final GDP and unemployment claims report will be released. The impact of the release of final GDP, gross domestic product, and unemployment claims data on the market can be significant as they are key economic indicators. Here are some potential market reactions to these releases. 1. GDP release. Positive GDP surprise. If the final GDP figure exceeds market expectations, indicating stronger economic growth than anticipated, it can have a positive impact on the market. Higher GDP growth often leads to increased corporate profits, which can drive stock prices higher. Sectors such as consumer discretionary, industrials, and technology may benefit from an upbeat GDP report. Negative GDP surprise. Conversely, if the final GDP figure falls short of expectations, signaling weaker economic growth, it can negatively affect market sentiment. Lower GDP growth might lead to concerns about reduced business activity and lower corporate earnings, potentially leading to a decline in stock prices. 2. Unemployment claims release. Positive unemployment claims data. If the number of unemployment claims is lower than expected, it suggests a strong labor market and can boost market sentiment. Investors may interpret this as a positive sign of economic health, potentially leading to higher stock prices. Sectors such as consumer discretionary and financials may benefit from a robust labor market. Negative unemployment claims data. If the number of unemployment claims is higher than anticipated, it can raise concerns about a weaker job market and overall economic conditions. This might lead to increased investor caution, potentially resulting in a decline in stock prices. Sectors dependent on consumer spending and discretionary purchases may be particularly affected. It's important to note that market reactions to economic data releases can be influenced by various factors, such as the overall economic climate, other concurrent news releases, geopolitical events, and market sentiment at the time. Additionally, the market often considers the data in relation to expectations, so surprises, either positive or negative, can have a stronger impact. To gauge the potential market impact of final GDP and unemployment claims releases, it's advisable to monitor real-time market data, follow financial news sources, and consult with financial professionals who can provide insights specific to your investment goals and risk tolerance. For June 30, 2023, Friday, Core PCE Price Index report will be released. The release of the Core PCE Personal Consumption Expenditures Price Index can have an impact on the market, as it is a key measure of inflation in the United States. Here are some potential market reactions to the release of the Core PCE Price Index. 1. Higher than expected Core PCE Price Index. If the Core PCE Price Index exceeds market expectations and indicates higher inflation than anticipated, it can potentially lead to a negative market reaction. Higher inflation raises concerns about the purchasing power of consumers and the potential for reduced corporate profits. Investors may become cautious, leading to a decline in stock prices. Bond prices may also decrease, causing yields to rise, as higher inflation erodes the value of fixed income investments. 2. Lower than expected Core PCE Price Index. Conversely, if the Core PCE Price Index falls below market expectations, suggesting lower inflation levels, it can have a positive impact on the market. Lower inflation might be viewed favorably by investors, as it implies stable or potentially accommodative monetary policy measures. This positive sentiment could lead to higher stock prices and potentially increased demand for bonds, causing yields to decrease. It's important to note that the market reaction to the Core PCE Price Index release can also depend on the overall economic environment, monetary policy outlook, and market sentiment at the time. Other factors, such as employment data, fiscal policy announcements, or geopolitical events, can also influence market movements. To gain a more accurate understanding of how the market might react to a specific Core PCE Price Index release, it's advisable to monitor real-time market data, follow financial news sources, and consult with financial professionals who can provide insights tailored to your investment goals and risk tolerance.